Most traders use the classic RSI without ever asking a simple question. What exactly is it measuring? And what important information is it ignoring? The standard RSI measures magnitude, the average size of upward moves versus downward moves over a fixed period. If the average up moves are bigger, RSI rises. If the average down moves are bigger, RSI falls. But here is the flaw. RSI doesn't care how those moves are distributed in time. It ignores sequence, it ignores persistence, and it ignores run behavior. Let me give a quick example. If price moves up sharply one time and then chops sideways, the RSI can print the same value as a market that moves up slowly but consistently for 10 candles in a row. In the math, they look similar. In reality, they are completely different markets. And this is where the RSI Run-Length becomes a genuine upgrade. Magnifying glass tilted left, what the RSI Run-Length actually measures. The indicator measures something the classic RSI cannot detect. 1. Run-Length of buyers. How many consecutive candles closed higher than the previous one? 2. Run-Length of sellers. How many consecutive candles closed lower than the previous one? These runs tell us something extremely important. Are buyers or sellers able to maintain control? Not how big the move was, but how consistent and how deterministic the pressure is. This is a deeper form of momentum. Momentum based on persistence, not amplitude. Then, just like Wilder did with the original RSI, you smooth these sequences using RMA, Wilder's SMMA. This creates two stable variables: the average length of buyer runs, the average length of seller runs. These values represent the structural behavior of the market. Then you build an RSI from those averages. This produces the Run-Length RSI. Direct hit. What the Run-Length RSI is really showing you: 1. True directional commitment. If buyers are closing higher for many bars in a row, even if the candles are small, the indicator shows strong upside behavior. A standard RSI would barely move, because the candles have small magnitude. But behaviorally, buyers are in full control. 2. When momentum is fake or weak. If the market jumps strongly upward, but then alternates up, down, the classic RSI rises sharply. It reacts to the size of the initial move. But the Run-Length RSI stays neutral, because buyers failed to maintain continuity. This exposes false momentum, something no standard RSI can filter. 3. Real exhaustion early. When run lengths shrink. For example, uprun 6, 4, 2, 1. The indicator detects loss of conviction before magnitude weakens. This means early signals of trend exhaustion, without relying on divergence or price reversal. 4. Cleaner overbought/oversold behavior. Overbought here doesn't mean price went too high. It means buyers maintained control longer than statistically normal. Oversold means sellers maintained control unusually long. This is much more meaningful than volatility-based RSI levels. High voltage. So why is it a true upgrade to RSI? Because it changes the entire philosophy of measurement. Classic RSI equals magnitude. How big were the moves? Run-Length RSI equals persistence. How long could one side stay in control? Magnitude can be random. Persistence is intentional. Magnitude is noisy. Persistence is structural. Magnitude can be pushed by one candle. Persistence requires multi-bar behavior, a behavioral fingerprint of real market participation. This makes the Run-Length RSI more accurate, more stable, and far more reflective of real buying and selling pressure. It does not replace the traditional RSI. It evolves it into something deeper, an oscillator that measures behavior, not just price distance.